Welcome back to Contributors Corner, where Michael Sakura and I break open the education and fundamentals for your portfolios. No fluff, just facts and finance. Now, you might be wondering where my co host Michael is today. Well, let's just say he's stuck explaining Bitcoin to his Nona and may never return at this point. Luckily for us, our regular crypto and blockchain extraordinaire, Bandeep Singh Rangar, is back with us, and he's the CEO of Fineqia and the perfect guest actually to help us make sense of this new wave of public companies putting Bitcoin on their balance sheets. Bandeep, it's always good to have you. Thank you for joining us again.
My pleasure. Always great to be on. And what a wild ride it's been in the crypto markets the last few weeks.
I cannot even imagine. I can't wait to dive into that. Let's actually start with something simple then for those new to the space. I mean, what does it actually mean when a company like Nakamoto or Metaplanet holds Bitcoin as part of its corporate treasury?
Sure. So, there's always been an investment thesis that if you have underlying assets, and typically they're venture capital assets or private equity assets, they are generally illiquid, right? So if you want to
Right.
get in and out of them, they're hard. But if you have a parent holding company that's listed, you get liquidity via the stock of the listed company. In the UK, where I'm right now in London, the famous company for that is 3i, which is a sort of the bellwether of the private equity market because they're a private equity company and they're listed. In the venture capital space, there's one called Molten Ventures, which used to be Tim Draper's UK venture capital firm, Draper's Spree before it was renamed to Molten, and Augmentum VC. And they're both listed companies. Now, typically, those companies would trade at par to the value of their underlying assets, which is called the net asset value of their portfolio, or quite often at a discount because the assumption in the market was one, they're illiquid, so there's a discount for the fact that you can't, exit your position on that immediately. And second, because they're private companies, there's still a certain measure of risk that you have to factor in, right? So you have to discount it for the implied risk and the illiquidity there. With Bitcoin, it's a bit the other way around, right? So Bitcoin, for one, has less or perhaps no operational risk. So there's not that kind of private company startup risk, if you may.
Mhm.
And second, it is assumed to be an asset that is going to grow in value over time. So unlike some of the other companies which may be growing, but there's still question marks, in Bitcoin's case, if you're long Bitcoin and you believe it's going to go from north of $100,000 today per Bitcoin to, that's US dollars, of course, to perhaps a quarter million and then over time to a million, then you are a long-term holder. So if you take that into account, then the companies that are effectively hoarding Bitcoin are building value for the future, and their market cap is reflecting that future value. Now, the interesting thing there is the premiums that are being commanded by these companies. So, a company like Strategy, formerly known as MicroStrategy, which is kind of the pioneer, Michael Saylor behind that, in 2020 started this whole notion of a Bitcoin treasury company. And he was questioned a lot of the time because it was sort of questionable whether people would buy into it. And what he did very cleverly was two things. One, he said, look, I'm long Bitcoin. I'm just going to keep accumulating a pile of Bitcoin, and that's going to be my balance sheet. He leveraged the initial operational aspects of the company where they had cash flow so they could borrow against it. And
Mhm.
he tapped into the bond market. So a lot of investors at the institutional level or even family offices don't have the mandate to go and buy cryptocurrencies directly. They can't buy kind of
Right.
naked crypto. They can't buy into wallets. So they have to look for proxies. So they will tap into Bitcoin treasury companies or other crypto treasury companies, or they'll go into ETFs. And that's one big reason why ETFs, and in Europe we have ETPs or ETNs, have been so wildly successful because investors are buying a regulated stock exchange listed instrument whose only value really is the underlying crypto assets. So they're buying a proxy for that underlying crypto. As you know, the bond market's are three times the size of equity markets. So Michael Saylor very cleverly went and created convertible bonds and said, look, you can buy as a bondholder a bond into my company, which would convert at a future price. And assuming that the price of Bitcoin goes up, the value of the equity in my company goes up. When you convert, you're effectively getting a discount to the future value. So you might buy it at 10, your conversion might be 20, but we think that the price of our equity will go to 30. And therefore, when you convert, you're basically buying into the future price of Bitcoin, but you're buying it as a bond today. So that allows you to meet your regulatory compliance or otherwise investors' mandates as to what you can invest in. So that kind of opened the floodgates for this now. I would say, copycat or rinse and repeat type of models.
Yeah.
Nakamoto is one of the most successful ones out there. Obviously, aptly named after Satoshi Nakamoto, the author of the Bitcoin white paper. And we've seen
Hmm.
that now play out with, Metaplanet, Matador in Canada, Liquid in the UK, Smarter Web, and other currencies that are not Bitcoin are being used by other companies that are imitating the same strategy, but with alternative currencies. So there's a company called DAO in the UK that's the London Stock Exchange. They're doing a little bit Tensor, which is an AI and BTC combination. And then Soul Strategies or DVDF Soul Strategies in the US and DVDF in the US, amongst others that are doing Solana-based strategies. And we've seen some
Right.
Ethereum-based strategies.
Right.
So, I mean, in a nutshell, it's the capital markets reward for holding crypto assets that is commanding a premium. Strategy, or formerly MicroStrategy, is got probably the lowest premium of about 2 times the value of their Bitcoin. Other ones are like 4 to 5 times. Soul Strategies is even higher. And at one time, they were like 17 to 19x their underlying holdings. So there was a lot of pent up demand, you may say, maybe perhaps a little bit of a hype, but overall, there's supply and demand disequilibrium given a huge amount of investor interest in holding crypto and few avenues for them to get it in a regulated, listed fashion. And that's really what they're tapping into.
Well, some people they're saying that this is just a bet on price. Others are saying it's a long-term shift in how companies protect value. I mean, what's your take? Why are you seeing more of these Bitcoin treasury companies now?
One big change that happened in the market that we're all, hugely aware of is a new U.S. president that came in about a year and a half ago, right?
Really? Huh?
So Trump has changed the normative for what is the regulatory position on crypto. So a few things that happened prior to him coming there were the opening of the ETF floodgates. So Bitcoin and Ethereum became accepted investable assets for investors, institutional investors to buy.
Hmm.
And subsequently, the initial premise of issuing a convertible bond or having a treasury play was you needed some underlying business, some underlying cash flow that kind of served as a bit of a backstop on the bonds that were issued. That's no longer needed. You do not need to have an operating business to issue equity or bonds if your business plan says you're going to buy Bitcoin or other assets. And that seismic shift has led to, at last count, almost 200 companies across the world that are imitating that strategy for effectively copying MicroStrategy now strategy for Bitcoin treasury play. So I think those two things have really changed the mindset. Now, is it a hedge against inflation? I think it's another asset that corporates keep on their balance sheet, just like the way they keep, cash or bonds. And there's of course this whole, play by companies to have an asset that's a hedge against inflation, and we've seen that not only with companies, but also individuals. You look at countries like Venezuela, where there's like 400% inflation, to countries like Pakistan or even Ukraine or Russia, where there's inflation due to the war, and a host of countries in between, like Argentina or Nicaragua, where there's again a play for anti-inflationary hedge that Bitcoin provides. So you look at
Hmm.
that thesis of anti-inflation that works on corporate and personal mindsets. And of course, corporates are hoarding it because they see it as another investable long-term asset, like they have cash and bonds on their balance sheet. So all that's driving it towards a Bitcoin treasury play with the omission of any underlying operating business requirement that was there before. There is a nuance here which I can get to if it's not an operating company, but happy to get into that now or later.
Okay, so actually let's talk about some of the models and the companies that you actually already spoke about. MicroStrategy blazed the trail. Metaplanet Japan is trying something similar. Nakamoto Brands has taken a different approach. Can you walk us through basically the key differences between these companies?
Sure. So as you said, MicroStrategy, or called Strategy, is the pioneer. They've had the good fortune of being the trailblazer. They, by the way, hold nearly 3%, I think at 2.84% of all global supply of Bitcoin. They're nearly at 600,000 Bitcoin, right? So they lead the way. Marathon Digital is probably the next one, and they're at like 0.23 of global supply. And then if you look at Metaplanet or Nakamoto, they're further down. But what's interesting about them is they have a slightly different play, not hugely, but somewhat different. So strategy is well understood. They, as I talked before, they hold it in treasury and they tap into the bond and equity markets very cleverly. Metaplanet being in Japan, if you're familiar with something called the Japan carry trade, a lot of investors would benefit from low interest borrowings in Japan because it's a low interest environment, and then lend them out in other markets at a higher rate. As long as you can manage the FX hedge, that's a good play to do. So Metaplanet is tapping into the same. They're actually issuing like zero coupon bonds, so no interest. And the bonds are sold at a slight discount in the market, which when they mature, pay the premium in the form of the difference between the discount and the face value. And they are tapping into huge amounts. I think they're looking to accumulate like 210,000 Bitcoin by 2027. That's their kind of stated ambition. So, them raising 30 billion in zero coupon bonds, that's yen, is their target. And I think that's very achievable. So they're tapping into their macro environment of low interest financing that's possible in Japan. Um, Nakamoto is slightly different. Nakamoto is playing sort of similar play, but they're more like a network. They have a number of treasury companies globally that they're backing. Some of the investors in Nakamoto are also involved with Metaplanet. They're also involved with Matador, Liquid in Canada, Smarter Web, and amongst others in the UK. And ultimately, they're basically doing a repeat play in different geographies. And I wouldn't be surprised if the same investors look at other markets beyond the ones right now. There's a few popping up in India. There's other countries like Turkey, which has a large cryptocurrency adoption rate. So I think they'll look at places like that. There's large economies like Poland that have not been tapped into. So I do think you'll see other copycats in that space, and the investors behind Nakamoto will obviously look at repeating that in other geographies. And over time, I think there's a couple of trends that we should talk about in terms of consolidation and also the opportunity for yield on these assets. I think those are two themes that are not very well understood in the market. I think it's worth talking about that, and critical mass and size. Yeah.
Well, is this sustainable or just hype? I mean, can these companies survive a long crypto winter, or are they just too exposed now?
Yeah, great question. So, strategy survived the winter like a few years ago, like in 2022 and late 21 when it peaked, and then it's managed to go through it because they've just had critical mass in their favor, and the prices that they've set for the converts have been managed. With 200 of them coming around, I think, Lindsay, that's going to be a bit of a challenge. I think there will be, I think three things will determine the future success of these companies. One is purely their size, right? The bigger critical mass, they become a bit, arguably a bit too big to fail. Second will be their management teams. People are looking at who's behind them, who's on the boards of these companies, who's the management of these companies. And that's going to be a critical sort of success factor for these companies because they've got the experience and the relationships to help manage any downturns. And the third will be the nature of the assets, right? So Bitcoin is arguably the most well-accepted crypto asset. But as you go beyond that to Ethereum or Solana, and those two are probably yet the more acceptable ones. But if you go beyond that to other coins, and there's nothing negative about those coins, but if you have smaller coins or coins that don't have the same institutional acceptance, whether it's Polkadot or BitTensor, which is still getting traction. People think about BitTensor as where Bitcoin was perhaps in 2010 when it started. Then those ones are still more nascent, and therefore they're more susceptible to any kind of winters that might come along. So I think those are the three factors to look at. But that might lead to consolidation. You might have larger ones gobbling up smaller ones, and I think that's what we have to look out for because right now even the equity markets are in a bit of a bubble, and when that air bubble, you're in this kind of hot air, and at some point they will, when the cooler sets in, some of them will implode, and you'll see perhaps the bigger ones survive.
So, I mean, you touched on it a little bit, but what should investors need to watch out for here? Are these stocks really a backdoor way to own Bitcoin, or are there hidden risks here?
Well, like there certainly are risks, right? So, some amongst the risks are also, what prices and what quantities are these treasuries buying crypto assets. That's not a disclosed item. So a lot of money's funds are raised, from the market with the promise of converting, but there's no, it's completely discretionary as to when they buy and what price they buy for. And that affects, of course, the net asset value. And if there's a downturn in the market, will their cost price be below water? And if you were to Google strategy, there's a whole bunch of like potential litigation cases out there. And of course, US is very litigious and you can't read too much into it. But there's, of course, you know, some silver lining of truth there about this discretionary mandate that's given to companies when they buy. Now, if you were a fund, you would have to adhere to a lot of regulation for what you can invest in, how you can invest in. But as a treasury company, you're sort of devoid of those, and that's one of the challenges in this model. The other thing is, you are holding Bitcoin and other currencies, but in the US, for example, you can't deploy more than 40% of your underlying assets in any income generating activities, because when you hit that tipping point, you become an investment holding company. So that's the same reason why, by the way, why ETFs are not yield bearing in the US. Now, you contrast that in Europe, for example, we launched a Bitcoin yield product this week with a target 6% interest rate. And we've got a huge amount of interest because we can deploy them for yield bearing activities. And we're looking at yield from decentralized finance protocols or DeFi. And that's just not possible in the US. So a lot of the US companies that are doing this now can at a maximum put out 40% of their assets in yield generation. So if you have $1 billion of crypto and you can only put out 40%, well, you're losing 60% there. You're leaving a lot of money on the table. So, is there a way to get past that? There's clever ways to do it, but not many. Or like MicroStrategy, or like you say, strategy, you just don't do it. You just hold it. And therefore you don't, fall foul of any regulation when it comes to income generation. But as you know, any smart investor wants to get passive income. And if you're in a stock, you get that in the form of distribution. Well, you can't get that. You can't get that dividend because that yield upside is limited. Right now, for ETFs, they're not even allowed. If they do start allowing for some like staking yield, there's still that threshold that they have to adhere to, 40% according to the US Investment Act. So the risks are, what underlying assets are they choosing? Are you comfortable with them? BTC is the most accepted, but they may not have the most upside. Right? We've seen Solana shoot up in the past few years, and you want to grab the next Solana or Solana itself. The second one is a management, because whenever there's a big frenzy in the market, we've seen that at the dot-com time, and of course, in the early days of crypto, you'll have less than fit and proper, shall we say, actors get in the space and take advantage of market euphoria. And the third, of course, is critical size, because if you don't have that critical mass, you can't withstand the shocks that'll come into the system. Because as we know, not only are equity markets and bond markets, especially equity markets, cyclical, crypto markets are notoriously volatile. And what goes up in crypto definitely comes down. And if you want to survive those, you got to look at the ones that have the depth and perhaps the backing of their investors. So some of them have got credit lines to buy. So if it's a downturn, they've got a revolving credit line that they can tap into within acceptable thresholds of price, and they can buy when it's low. They actually might be better off because they're buying on the low and averaging down their price. So you got to look at those details, right? How susceptible are they to the investor? The terms of the funds that they've got from investors, can they buy when it's low? Or are they stuck with certain option convert prices that could leave them underwater? And I think the devil's in the detail there, and investors should really look out for those details carefully, because otherwise there's too much of a discretionary mandate given to the Bitcoin treasury companies without you thinking that you're giving the discretion away.
Yeah, I mean, there's a lot that you definitely have to look out for, and strategy is one of them. So let's talk about that. I mean, if I'm bullish on Bitcoin but don't want to deal with the wallets or the exchanges or the self custody, does buying into these companies make sense, or are there smarter ways to get exposure?
So there is obviously the ETF industry is entirely premised on that, where you're buying exposure to Bitcoin. You're actually getting the underlying crypto, whether it's Bitcoin or Ethereum or Solana or Cardano, and you're buying it through a regulated listed instrument. And what you have to look at there is, you're not paying the premium in the market for it that's there right now with these treasury companies first. Second, you got to look at the cost of doing so, because typically the ETFs have a lower fee structure. So, it's lower sometimes than buying crypto directly from crypto exchanges. They'll charge you 1 or 2%, whereas ETFs may be like some basis points on their fees. And you're also getting yield on these, and some of them certainly in ours and some other ones in Europe, which again, you don't necessarily get from a Bitcoin treasury company. And then you have to look at is the premium going to subside? Because as I said at the very outset, typically your market cap for listed company is at par, sometimes at a slight premium, but more often than not at a discount to your net asset value. So that normative is going to apply to this sector as well. It's a matter of time before that premium subsides. So which side do you want to be on at that point? Now you do get the benefit of not having to deal with custody and other issues of holding crypto when you go through either a treasury company or an ETF, but you're also not getting the yield that you have. And I think ETFs in that way are better. And at some point, I think these will merge, right? These are not universes that are completely disparate. There's an argument for having companies that do a bit of both, and they get the best of both worlds.
Okay, so let's just zoom out a bit here. What do moves like this say about the future of corporate finance then? I mean, could we one day see Apple or Amazon make a similar play?
Yeah, I think the fusion of traditional finance and crypto finance or decentralized finance is here. But to quote Bill Gates, like you always underestimate in the short term how long it's going to take and overestimate in the short term how long it's going to take and underestimate the long term the impact, right? So in a 1 year view, you think a lot's going to happen and it doesn't happen. On a 10-year view, you go like, wow, we've done so much in the past decade. And I think if you look at some of the moves in the past week, a lot of the crypto companies are applying for banking licenses, right? Circle announced that, Ripple announced that, the exchange called Kraken announced that. Circle's IPO, which went up to like 675% of their offering price, was a major indicator of pent-up demand. It's gone down a bit since then, but it's still, I think, about 500% above IPO price. So that to me indicates that traditional finance is really interested in crypto. Will companies like Apple and Amazon move into that space? Undoubtedly they will. How they go about it is a question mark. Will they create their own stable coins? Because there's a whole, stable coins are the new kind of darling of Wall Street with Circle's IPO. And there's talk about banks having their own stable coins, certainly banks accepting stable coins and having them as deposits in customers' bank accounts. So I think that stablecoins will probably be the initial fire that stokes this fusion of crypto and decentralized finance. But over time, there will be no difference between owning a token and a share. Like, I don't think it's that far away that, stock exchanges like the New York Stock Exchange or NASDAQ offer tokens. And then the question is, what do the crypto exchanges do, like Binance or Coinbase or Kraken, right? So will they start offering equities? And you saw Robinhood in the past week announce that they're tokenizing European equities and offering them as tokens on their platform. Kraken has announced that they want to offer tokenized stocks and ETFs or ETPs across the world through tokenization. And at some point, there'll be some kind of collaboration amongst various token exchanges like Kraken and Coinbase and Binance, amongst others, Bybit, OKX, to basically allow for some kind of seamless transfer of tokens amongst them and in a permissionless way, which is what crypto is about, to create global liquidity. So when you have a global 24/7 liquidity in that market and that crypto market's fusing with the traditional finance market, the stock exchange will have to respond accordingly. They will also go the same way. So I think if you fast forward, there should be not much difference between tokens and shares. There should be not a lot of difference in you holding in your account Canadian dollars, US dollars, or a stablecoin reflecting that. And you will get versions of that give you yield or don't give you yield, just along they sit alongside you holding BTC or ETH or other cryptocurrencies. And decentralized finance, which is now on the blockchain, mimics what's happening in the non-crypto world, right? You lend, you borrow, you provide liquidity. Those kind of things will again move to traditional finance, where a lot of the current functions of paying agents, collateral agents, cash verification, trust companies is replaced by smart contracts. Like there's a extra burden in the traditional finance world on third parties that the blockchain world is aptly suited to just make much more efficient on a both cost and time basis. So I think that revolution is well underway. And even you refer to down cycles in the crypto market, which is which happens. We know that's extremely cyclical and volatile. But the underlying transactions that take place despite having market downturns is generally headed up. Even the last cycle when you had Bitcoin price drop, the volume and value of transactions that were being validated on crypto networks didn't suffer correspondingly as much. So like the underlying infrastructure is still building up. And that's now meeting traditional finance at various points of intersection, the most Optically visible ones are the banking applications that cryptocurrencies are
Right.
making. And soon I think you'll see banks buying into crypto companies.
About time, for sure. All right, Bandeep, before we let you go, it's time for a round of rapid fire. So it's 6 questions, 2 minutes, no overthinking, just whatever comes to mind, one word or one sentence. Are you ready?
Okay, we'll try this, sure.
Okay, here we go. Number one, Bitcoin or Ethereum. If you could only hold one for the next 10 years, which one would it be?
Bitcoin.
Bitcoin. Oh, right out of the gate. There we go. One crypto term that drives you crazy when people misuse it.
Oracles.
What are oracles?
Oracles are a way to get pricing from external sources that feed into decentralized finance or on-chain activities.
Okay. Next one. What's the most underrated country quietly embracing blockchain tech right now?
Ooh, El Salvador.
El Salvador. A little bit stumped there. I like that one. Okay, next. If you weren't in finance, Bandeep, what would you be doing right now?
I would be looking to build a crypto company or join an existing crypto company because that's where the future is.
All right. And a hot take on stablecoins, financial innovation or a ticking regulatory time bomb?
Well, caveat disclosure, obviously I'm involved with a stablecoin called STBL.com, which I'm setting up with the co-founder of Tether, Reeve Collins. So I think it's the future. And if you play it cleverly, there's going to be some very interesting, promising bets to be made in the space.
Okay. What's one crypto project you think everyone should have an eye on, but nobody's talking about yet?
Oh boy.
Stumped you.
It's hard to get one. Well, Yala is an interesting one. Hyperliquid is an interesting one. Certainly, I would say our project stable, STBL.com is an interesting one. There's a few out there that it's hard to just pinpoint on one. But I
Right.
certainly think those three come to mind.
All right. Well, Bandeep, it's always a pleasure picking your brain. Thank you for making crypto just a little bit less cryptic for us.
Always a pleasure, and hopefully, your audience feels the same way. And I'm not overly technical, but I try to keep it as simply explained, but still getting the sophistication of what's happening in the crypto markets communicated.
You are great at it. Now, again, that was Bandeep Singh Rangar, CEO of Fineqia. If you want to learn more about what they're doing in this space, check them out at fineqia.com. And don't worry, Michael will be back unless his Nona buys Ethereum and then wants to learn about gas fees. And then we don't know. So, of course, here comes the disclaimer. These conversations are packed full of useful knowledge for your portfolio decisions. And remember, these are the opinions of our own with vested interests in particular assets and companies. So always be sure you speak with your own financial advisor and know your own risk tolerances. For a copy of our full disclosure, head to the article below. I'm Lindsay Melchek. Thanks for watching, and we'll see you soon.